Hi guys, and welcome to this Saturday's Money Market Update. So we've had the latest inflation report out of the US and nothing fell in price. In fact, annualized inflation in the US now is actually gone up from 8.2 to 8.6%. And the bottom line is Jerome Powell and the US Fed has failed. They have been horrible with respect to their expectation on inflation. They've been far too slow with respect to their reaction to inflation. We now have a central bank and other central banks around the world as well that are going to need to become far more aggressive in the coming months ahead. I sat my wife down yesterday and I sat my kids down today that all have investment accounts, and we have portfolios here obviously at home in the family that I look after. And I want to share with you today some important things because I've got some notes that I've written down here today after spending some time listening to, contacting some colleagues of mine and listening to some respected investors. And there are things that you need to know as an investor right now to make sure that you can navigate your way through this challenging period, feel comfortable about what you're doing to make sure that you don't make the common mistakes that the average investor makes, and that in 2 to 3 years from now, you're out the other side of this potentially recessionary period with a portfolio that is thriving and doing well. So let's cut to the chase. The demand needs to be destroyed because prices keep going up, because consumers keep spending money. And the only way to stop the consumer from spending money, the only way, is to aggressively raise interest rates. Now, the RBA here in Australia won't need to be as aggressive as the US Fed because inflation in Australia is 5% thereabouts, a little higher than 5%. They raised rates again recently, but here in Australia it's only 0.85 of 1%. You know, if Jerome Powell and the committee of the Fed was a CEO and board of directors of a company, they most likely would be sacked by now. And Joe Biden, when he became president, he campaigned on the back of the fact that he was going to hand out all his money when he became president, and he needed to fulfill that commitment. The US economy did not need the stimulus that Joe Biden injected when he became president. The US economy did not need interest rates to stay at zero until 2022. The US economy did not need the ongoing injection of massive amounts of stimulus, of mortgage-backed securities and buying bonds and assets that nobody else was going to buy all the way through 2021 and into 2022. It didn't need it. We're at June the 11th, 2022. Before June the 11th, 2021, it was obvious that the Fed needed to raise rates and stop the stimulus. So right now, I want you to know something that's important. Central banks are going to need to get interest rates back to at least 3% or higher to crush this demand that we have. Now, we'll get onto oil in a moment, but this is potentially going to take 18 months to 2 years. Now, we have never seen in history before a period where US inflation has been above 5%, the Fed has raised rates to bring inflation down, and we have not seen a recession. I have consistently through this year said, I don't forecast macroeconomic events, etc., which I don't. That's not what I do. I'm an investor, just like you are. But we need to be realistic and understand that the probability of the US and Australia seeing a recession in 2023 is well more than 50% right now. That's the reality of it. And the reality also is that when financial markets fear a recession is going to occur, we generally see financial markets sell off between 25 and 50%. In 2000, the S&P fell 50% when the tech bubble burst. In 2008, in the global financial crisis, and March 2009, when the US market hit its lowest point, it was down 50%. When the US had a recession, a short, sharp recession in 2021, the global economy had a recession in 2021, a short, sharp one because of the pandemic, the S&P fell down 38%. The NASDAQ was down a little more than that. I'm not going to predict how far financial markets are going to fall. But I'm just saying to you now that you need to gear yourself up, if you're an investor, to close your laptop, close your profit and loss statement, and leave it alone. If you own great quality businesses, those businesses with respect to their share prices, the probability based on what we're seeing from a monetary policy, historical perspective, the way financial markets behave from an historical perspective, the probability is share prices this time next year are probably still going to be flatlining or potentially even lower. The only way that share prices would be higher is if we saw inflation come down, demand destruction happen, and oil prices fall substantially. And oil prices are not going to fall substantially in the next 6 to 9 months, because there has not been enough capital expenditure spent by the big oil producing nations to be able to increase enough supply to meet that demand. Around about $1.5 to $1.7 trillion needs to be spent in capital expenditure by oil producing nations just to get supply to meet demand. That does not even include the fact that Europe is going to decrease its its reliance on Russian oil by 95% by the end of this year. The Saudis, the Venezuelans, those in the UAE, the United Arab Emirates, they cannot increase enough supply to meet the demand. So oil prices are going to stay high. That is going to put upward pressure on inflation. The only way we're going to see inflation come down is if consumers stop spending money. And the only way to get consumers to stop spending money is to put interest rates up. And when interest rates go up, we generally have an economic slowdown. And in the particular backdrop that we have right now, the probability is better than 50% we will see a recession. Now, we may not see a recession. We may see the Fed and the RBA and the Bank of England, the European Central Bank thread the needle, and they don't get a recession. But the point that I want to make is that businesses are doing better than the share prices suggest. So right now, share prices are declining substantially in 2022. S&P's down about 18%, NASDAQ is well over 20% down, maybe about 25% now. The companies such as Alphabet, Microsoft, Amazon, these types of businesses, the underlying backdrop in those businesses is doing very well. But of course, what traders are pricing in right now, what the market is pricing in right now, is the fact that we are likely going to see a recession going forward. Now, this is important to understand because there will be some of you that will watch this video and say to yourself, well, if we're going to see a recession, I'll just sit back and wait. I won't do anything. I can promise you one thing. If we do see a recession in 2023, by 2024, 2025, the probability is history shows that recession will be over and financial markets will have genuinely and meaningfully started to recover. You cannot sit back and go, well, I'll wait for things to get better before I start to invest. You will look back in 2024, 2025, and you will look back on 2022, those of you that have got cash now, and you wish you had have put more money to work in 2022. Now, we may see prices lower in 2023, the first half of 2023. Nobody knows where the lowest point in price is going to be. But what we do know is provided you own great quality businesses, they're going to be thriving in 2024, 2025. And there's no point waiting for them to be thriving before you start to invest in those businesses if you want to genuinely earn meaningful returns on investment. So if you own businesses right now that don't have high amounts of free cash flow, if you own businesses right now that don't have sizable share buyback programs, or if you own businesses right now that don't have dividends, and you own startup businesses that have no free cash flow, etc., then your portfolio is in real strife. But if your business, the businesses you own have high cash flow, free cash flow, they pay dividends, they have share buyback programs, they've got big, powerful, predictable earnings, they've got solid economic moats and great balance sheets, you're going to do just fine. But you're just going to need to come to the realization that what happened in 2020 and 2021, everybody thought the financial markets was like licking ice cream. Everybody thought, how easy is this? Because it had such a tailwind from the Fed and central banks and stimulus programs like we saw in Australia with JobKeeper, like we saw in the United States with the stimulus programs there, where basically they were flying around helicopters around the world, throwing out money straight in the back pockets of consumers. Consumers around the world right now are richer than ever. But let me tell you this, the US consumer will not stop spending until they are slapped in the face. And US consumers and consumers in Australia, they're going to get slapped in the face in the next 6 to 12 months because oil prices are not going to come down, interest rates are going to go up, and the cold, hard reality of the day is going to take hold, and people are going to realize, you know what? I need to stop spending as much money. And that is when we will see inflation come down, and that is going to take time. Now, if you feel anxious and if you feel forced that you need to hang on to the businesses you own because they've fallen by 30 or 40 or 50%, and you feel anxious about, I've got to hang on to these businesses now, I can't afford to sell them, and you can't feel comfortable about what I just said about 2024, 2025, then you shouldn't be in the share market and you own the wrong businesses. The vast majority of my clients at Trading Mastery should feel comfortable in the notion that they have portfolios of wonderful businesses that will be thriving in the years ahead. And they understand about the importance of patience. I am just simply emphasizing today that that patience is going to need to go to an extreme level, right? Right now, the S&P 500 is selling at 17 times earnings. If you take out the tech companies, the balance of the S&P is trading at 13 times earnings. Now, if you look at history, it's very rare that that has happened before. So what I'm saying to you is right now, the S&P is starting to get very cheap. Just because I've said and others have said, and the likelihood is we will likely see a recession in the US, does not mean that share prices are going to continually go lower and lower and lower. That it has already been priced in to the market already, the substantial likelihood of a recession. Now, I'm not saying the prices can't go lower. They could go lower, but they may not go lower. If inflation starts to come down in the second half of this year, share prices just may flatline for the next 6 to 9 months, and then they may rally as the economic recovery starts to occur. But the bottom line is these few things need to happen. Demand destruction of consumers needs to occur, and that is only going to occur if central banks get more aggressive, and they are going to get more aggressive. Those of you with cash, Do not think that you can wait until 2024, 2025, or even into 2023 before you start putting that money to work. You need to be putting that money to work in great quality businesses that have high free cash flow, that have big economic moats, great balance sheets, big buyback programs. I can tell you right now, Apple, Berkshire Hathaway, Alphabet, Microsoft, these types of businesses, in the coming quarters, we will see that those businesses have been buying back huge amounts of their own shares. Just wait and see, because they know they're cheap. And that actually rewards loyal shareholders of those businesses long term, because every time they buy back the shares and retire them, the shareholding of the individual, the slice of the business that they owned, gets bigger. So there is some negatives for 2022 if you want to focus on the negatives. We could see a recession. We could see economic growth slow. My portfolio may not rise this year. I might finish off the year flat. I might even finish a little negative. But as a private investor, who cares? We're not a managed fund. We're not here to wave a red flag and say, oh, look at the performance of our fund by the end of the year. You're here to make meaningful returns on investment over the long haul. And the way to do that is to own good quality businesses and sit through periods that we're going through right now, but also take advantage of what is going on. So right now, guys, if you have questions about what's going on, put them in the comments section. I'll do my best to answer them. If there's something you're not sure about, if there's something you want to know about, I don't have the answer to everything, but I've been doing this for a long time now, and I would like to do my best to help you. But we're all going to need to be patient. It's going to take some time. I won't be stopping investing. I've put more money to work this week. You guys know that. I will continue to put more money to work throughout the course of 2022. But most importantly, I will keep my temperament in check. And you need to keep your temperament in check as well. And we will make sure that over time, our portfolios continue to shine as they have done in the past. Have a wonderful weekend. Give me some feedback in the comment section if you have a question. I'll see you next week.